This is Matthew Kratter's Bitcoin University. Today I want to talk about Bitcoin stocks, gold, and houses, all of them as a store of value. And this is a follow-up to yesterday's video asking whether Bitcoin is a safe haven asset. And as part of that video, I talked about gold as an inferior store of value compared to Bitcoin due to gold's dilution risk. Because unlike Bitcoin, gold's future supply is not known. I referenced a couple of articles that may have been a little bit questionable. This one about the 90% gold mountain in Africa, and this one about Pakistan striking gold. I probably should have referenced this one as well, this asteroid that has $700 quintillion worth of gold in it, that has enough gold to give everyone on Earth $93 billion worth. So there's a response from Jamil Dunn. Respectfully, the gold dilution issue is an exceedingly small risk. People are finding deposits of gold all the time, but finding them and getting them out of the ground are two totally different things. It can take 5 to 10 years to stand up a new gold mine, and even then you're not going to be able to get all that gold out at once, which is certainly true. There are deposits people have been mining for over a century, so even though it's easy to find headlines about gold deposits found, that doesn't mean the gold supply is going to get diluted tomorrow. We've rarely been able to exceed 1.5% dilution rate, even with modern mining techniques. That's about correct, somewhere between 1 and 2%. Yes, overall BTC is better, but more because gold has to be centralized due to physical difficulty of moving it, and there's no real way to confirm who actually has the gold, leading to rehypothecation. I agree with all of this. My response: at a 1.5% dilution rate, the total above ground supply of gold doubles every 50 years. So even at this very conservative extraction rate, the above ground supply of gold doubles every 50 years. That means that you've lost 50% of your purchasing power in less than one human lifetime. That makes gold a suboptimal store of value. And then Free Sovereign responded to that: as price increases, so does incentive to improve technology for extraction. And that's true. By contrast, when the price of Bitcoin goes up, you can't mine more gold. You can't mine more Bitcoin. There's nothing you can do to increase the extraction rate. Supply is still finite and blocks only every 10 minutes on average. So that's the difference. What we say in economics is that Bitcoin has an inelastic supply. No matter how much demand there is for it, it doesn't increase the supply or draw out new supply as it does with gold. Here's the calculator I use for this: approximately 47 years to get something to double, to go from 1,000 to approximately 2,000 at a compounding rate of 1.5%. So that's why I came up with the fact that it takes about 50 years to lose 50% of your purchasing power, or 47 years. If you're enjoying this video so far, I just ask you to help to support this channel's educational mission. Hit the subscribe button. That does really help with the channel's reach and growth. Leave a like, leave a comment, question, suggestion for a future video, and share this video with a friend or family member. Another response to this video from Ian H43: how come Bitcoiners always talk about how Bitcoin can ride the wave of fiat monetary base expansion and is therefore an inflation shelter, but never mention other assets like equities that do exactly the same thing? Granted, there's still the aspect of self-custody and sovereign control of the asset to laud, in addition to the headless nature of the globally distributed network. That's true. But I feel like a lot of Bitcoiners act like BTC is the only thing that responds to inflation, which is just misleading. I suppose another argument could be that it's more sensitive to inflation, assuming the data that back that up. Just wish these points were brought up in conjunction more often. And then a follow-up comment: one other potential argument could be direct usage in a Weimar scenario, I guess, to avoid hyperinflationary intermediary. In other words, holding Bitcoin and spending it in a hyperinflationary time. So this is all partially true, and it does help to explain the paradox of why stock markets in failing countries often appear to be doing really well. It's because of this function of equities as a partial, at least, inflation hedge. So stocks in these countries, you'll see them appreciating in the local currency, just as they have been in the US dollar as well, as the US dollar has been losing purchasing power year after year. But in these usually global southern countries, or what we used to call third world countries with very weak currencies, stocks are appreciating in the local currency, but the local currency is usually losing purchasing power at a greater rate then the stock market is going up. This is very key, and this is why stocks are not a perfect inflation hedge. Do you really think that investors in these failing countries are getting rich? If we take a look at the stock charts, Venezuela's stock market, it looks like the NASDAQ in 99 and 2000 just going straight up. Same for Zimbabwe's stock market, though it has pulled back, but this is just going completely vertical. And again, this is because of currency devaluation and depreciation. This is not because in Zimbabwe there are all these companies doing amazing things. Same thing goes for Turkey. We can see just tremendous stock market returns, but it doesn't matter if you're holding Turkish lira that it's denominated in. So this is the paradox, and this is what happened as he refers to Weimar Germany. Even in hyperinflationary Weimar Germany, everyone was speculating in stocks and real estate, never realizing that they weren't actually getting rich or even just treading water in terms of purchasing power, because in Weimar Germany, the money too was losing purchasing power at a faster rate than the stocks or real estate were appreciating. There's a great book about it called When Money Dies by Adam Ferguson. I'd encourage you to check out. Stocks and real estate are much better stores of value, inflation hedges than holding cash, but they're still not nearly as good as Bitcoin. And this is why Bitcoiners are obsessed with Bitcoin, and they're not talking about how you should store your savings in stocks, because they really are inferior. They have operational risk, they have jurisdictional risk, they have all these other risks. And also gold is far inferior to Bitcoin, even in non-hyperinflationary times. So stocks, real estate, and gold inferior even in hyperinflationary times. We've seen this with the gold Bitcoin exchange rate just plummeting year after year after year. And if we scroll out, we can see how devastating it has been. And so if you're holding gold, if you're a gold bug versus a Bitcoiner, you're going to continue to lose purchasing power, economic value, and thus political power. So you don't want to be a gold bug. A bearer asset we talked about many times on this channel. It's an investment. If you hold it, you own it and control it, and no one can freeze it or turn it off. Think of the cash in your bank account. It's very easy to freeze. They can just tell you, oh, you can't withdraw this much cash at this point in time. So cash in your bank is not a bearer asset, but perhaps cash, physical cash in your pocket probably is. But a better example would be a gold coin held in your hand. There's no counterparty risk, and that gold coin will be accepted by almost anyone in the world, not just people who live in the country where it was minted. It's the fact that it was made out of gold. Now, Bitcoin can be a bearer asset too, and a much superior bearer asset to gold. Bitcoin can be a bearer asset too if you hold your own private keys. It can be taken anywhere in the world. You can store it in your head by memorizing just 12 words. These are all superior qualities compared to gold. Physical gold can be held as a bearer asset as well, but again, much less portable and easy to verify. Now, comparing Bitcoin and gold to stocks, this is another problem with stocks. Stocks are never, ever a bearer asset. You may see things like bearer certificates. They're not true bearer assets, in my opinion. Stocks are just equities. That's another word for them. And they're called equities because they constitute ownership or partial ownership or equity in a company. And equity in a company is enforced by the existing legal and judicial system and is dependent on your society not collapsing. This is why I think that stocks can never be a true bearer asset, because they're so dependent on context and the existing civilizational framework. In the 20th century, the Russian stock market went to zero once, and this German stock market went to zero, I believe, twice, both World War I and World War II. In times of war and crisis, you want a bearer asset, not an asset that's dependent on the courts and the police to protect, as stocks and bonds are. Real estate appears to be a good inflation hedge, but it's not really. We've talked about this before, but just wanted to include it here briefly. Endless maintenance costs, property taxes, insurance costs, maybe HOA fees, and then very high transaction fees to enter and exit the property. People will brag that they're up $200K on their house, on their investment, or on their primary residence, but then they forget to tell you about the $20,000 AC that they had to replace, the $60,000 roof, etc. They never include these in the accounting charges. Also, it's important to compare apples and oranges, because most people put down something like a 20% down payment on a house and finance the rest. So we're talking about investment that's levered 5-to-1 when you're looking at returns. So it's probably not fair to compare that to a completely non-levered or unlevered Bitcoin position in terms of returns. Real estate, just like stocks, is also subject to extreme jurisdictional risk, mostly because it cannot be moved, unlike Bitcoin. So if you were a landlord during COVID, we've spoken about this before, you had to keep paying your mortgage while your tenants got their rent payments paused by the government. All it takes is a roll of sheriff's tape to impair your real estate's value. This is another reason it's not a true bearer asset. And there was a comment on a previous video that I'll link to in the description notes below about whether you should buy a multifamily rental or Bitcoin. And the answer obviously was Bitcoin. And Saratoga Pilot 6100 had a very interesting answer and a very sad comment. The problem with any real estate, and especially rental properties, is that the government can and frequently does confiscate such properties through a combination of rent controls, property tax, and mandatory structural code upgrades. I know from experience, I have a 15-unit apartment building on Nob Hill in San Francisco that I cannot sell. So that is many millions or tens of millions of dollars locked up there and trapped in San Francisco, unfortunately. These are the reasons that real estate is in the process of being demonetized by Bitcoin. You're always going to need a roof over your head, but investors will not want to own a second investment property if they can own Bitcoin instead. And wealthy people are not going to have 5 or 10 houses in order to sort of spread their money around. They'll just put most of that into Bitcoin because it's much more convenient. You don't have to worry about maintenance and upkeep and theft and all these things. And this is also why I sold all of my rental properties 5 years ago and moved the money into Bitcoin. And I'm very, very glad that I did that. We can see that the price of housing, the price of real estate keeps going down year after year if denominated in Bitcoin. So if you're holding Bitcoin, the price of houses keeps getting cheaper. Back in 2012, the median home price or the median home in the US cost 43,000 Bitcoin. In 2016, it was down to 531 Bitcoin. In 2020, you could get the median price for priced home just for 33 Bitcoin. And we can see all the time that the price of the house denominated in dollars is going up, but denominated in Bitcoin, it's going down. And now it just costs about 5.8 Bitcoin to secure the median price house. And this is true in the UK as well. For the UK, England, Wales, and London, prices down, denominated in Bitcoin, 99% since December of 2016. That seems like quite a high number. I'm not sure it's quite that much, but it's probably somewhere around there. If you enjoyed this video, be sure to hit the subscribe and like buttons. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks all for watching, and I'll see you in the next video.